Finance Chapter, Section 2, Individual Retirement Account, or IRA. In 1975, this was the first time that an IRA was available to citizens of the United States. It was a plan proposed by the government to encourage individuals to save for retirement so that they had income other than just depending on Social Security. Money is held in a custodian institution such as a bank or a brokerage, and it's generally growing interest from being in either a certificate of deposit or perhaps ownership of stocks or mutual funds. Today that's called a traditional IRA. We also have a Roth IRA, but we're going to mainly focus on a traditional IRA. It's going to reduce your taxable income today. It's known as a tax-deferred savings plan. You do not have to pay income tax until money is withdrawn from this account. You may access the money in an IRA at the age of 59.5 years old. You also can borrow against that money for a home mortgage and also to help with tuition costs of your children. Here's what it would look like for an individual earning $30,000 without an IRA. They're in a tax bracket of 28%. The tax owed then, by the calculation of taking the base income times the tax rate, results in a tax obligation of $8,400 of their $30,000 is being paid for taxes. Versus if you have the same situation, $30,000 income at a 28% tax bracket, but you decide to put $3,000 away for retirement. That means your taxable income will be reduced by that amount that's put in the individual retirement account. So instead of $30,000, you will have a taxable income of $27,000. This is kind of a win-win. You have $3,000 that's going to be growing and earning interest tax-free during the years until you're 59.5 years old as a minimum, and it's saving you tax today, or at least reducing your tax obligation. So 27,000 times 0.28 means tax paid today on that same income, but by putting $3,000 into an IRA, has a tax obligation of $7,560, which is a little over $900 difference between having an IRA and not having an IRA. Here's another example. Someone has an income of $45,000. They put $4,000 in an IRA or a tax-deferred savings plan. That doesn't mean that they won't pay tax, but the idea is when they withdraw the money from an IRA at retirement, they're most likely going to be in a lower tax bracket so that the tax amount will be less at that time. So what's the savings? If there was no IRA, we would take the gross income times the tax rate with a tax amount of $14,400 paid out. With an IRA, the $45,000 turns into a $41,000 by subtracting that $4,000 IRA contribution. Multiply it by the tax rate, means taxes paid for this individual with the contribution is only $13,120. The amount saved is the difference between no IRA versus an IRA, and in this case, today their savings on their tax bill is almost $1,300, plus they have $4,000 put away for their golden years. There's practice on these types of problems found in your textbook on page 30.